Great, thanks, Fiona. And yeah, it sounds like I need a life. That's
Yeah.
my wife keeps saying I need to find a way to retire. So we're working towards that one day, but you never know. And look, I've got to say up front too, had a quick chat to Fiona and Gabby before we started. The way I like to do these things, webinars are hard. So if you've got any question at any time, or you want clarification on something, or there's something that I say that you think doesn't make sense, please just send a chat message to Fiona. And I've given Fiona permission to stop me, when I take a breath and ask that question, so that I'd rather have a more interactive session than just sit here and listen to stuff. So with that, I guess I'll start. And please, no question's a silly question. What comes out of the changes from the exposure draft built on the tentative decisions that the AASB issued in 2019 that a lot of people sort of weren't really aware of, and it will create some challenges. I'll be honest. It's going to really challenge, particularly in Victoria, probably the audit office, and it will certainly challenge the Valuer General's office. So we're trying to get consistency across the jurisdictions. People like me who work across all the jurisdictions as well as internationally, we get so frustrated because it's different rules which make no sense necessarily in some jurisdictions. But you've got to comply with whatever the prescribed requirement is in that jurisdiction. So hopefully out of this whole process, we will get some consistency across all of Australia. And we will get a clearer understanding of what the prescribed requirements actually are versus what people think they are. Okay, so in terms of the agenda, I guess I've got 4 key points here. I want to give a bit of background to ED320. Obviously, ED320 has closed now. My expectation is that the AASB will make, unless there's something miraculous comes out of the consulting, my expectation is that what's in ED320 will come through into AASB 13 later this year. I want to delve into the key aspects and implications for Victorian local governments. As mentioned before, I did do a session at the face-to-face meeting in Melbourne not so long back. Unfortunately, we were under extreme pressure to get that session started late, and we had to get it finished on time so that the Mayor of Melbourne could talk, because she was under a tight time frame. So I think my 40-minute session ended up being about 20 minutes. So we only skipped over it. So this, I guess, is a good chance to go through in detail as to what's there. And there are some big implications for Victorian local governments. Then I want to talk about, based on what I've said, well, what needs to be done, and I stress there are some challenges here, and some people are going to sit there and go, oh, Jesus, it was hard enough now, let alone having to do all this extra stuff. What I will say is it's not that hard. It's just about, you've got to change the way that you think about doing these things. And once you recalibrate that process, you'll realize there's no extra work and it doesn't take any extra effort. It's just some small changes. And then I want to talk about compliance strategies in terms of, depending upon where you are, in terms of what I talk about today, what do you do about it? There are different timeframes. So, for example, the exposure draft talks about a 2-year transition period, but you also have to realise that some aspects of the exposure draft clarify what the existing requirements are. So they're not changes; they're required now. You don't get 2 years to play with them. They are what the standard is now. Okay, so background to ED320. So it was issued back on 31st of March. Responses closed 30th of June. So it's still fresh in the mind of all those people who put submissions together. I have seen some submissions from a few local governments around the country who flicked them my way to have a look at. Generally speaking, they've all been pretty consistent. And probably the biggest issue that's affecting a lot of them is the issue with restricted land, but I will talk about that later. So I guess a couple of little things here. It was released in March. It talks about 3 key things: market participant assumptions, the asset's highest and best use, and the application of the cost approach. And that was more around the calculation of the replacement cost as opposed to current replacement cost. In terms of application date, yeah, they're talking about, you know, a 2-year transition period. However, like all exposure drafts, they also allow for early application. So what that means is if there's something that you want to change now, there's nothing technically stopping you doing that. Having said that, you know, I know that the way that some jurisdictions work, sometimes the local government department or the Auditor General or whoever tends to want consistency over anything else. And sometimes they will say, no, we're all doing it on this date. If that's the case, that's the case. But just understand there's nothing stopping you going early necessarily. If you want to go early with some of these things, obviously have a good chat to your auditor. Okay, so what are the key aspects and potential implications for Victorian local governments? And I guess there are the 3 key things that were noted in the actual front of the exposure draft, and I'll talk about them. But the other thing was there was a range of bases or conclusions that attached to the exposure draft, and those BCs will also be included in AASB 13 when it's made. Now, for those who know accounting standards, you'll know that there's the actual accounting standard itself, so AASB 13, and accompanying the accounting standards, there's also a basis of conclusion, and normally there are also illustrative examples, and all of them get read in conjunction with each other to be the overriding prescribed requirement. So just because something says something in the actual AASB itself, you also have to comply with whatever's in the basis of conclusions paragraphs and the illustrative example paragraphs. So I just want to work through them. And again, as I said, restricted assets seems to be the biggest issue. When the special project for fair value in the public sector was first formed, I think I was approached, I'm going to say mid-2015, and I think we got appointed December 2015. And if you think about that, that means it's been 6 years, you know, where we've been looking at all these issues. And there were about 5 or 6 big issues identified in the first meeting. And number 1 on the agenda was restricted assets. Now, you've got to understand, for people like me who work across the different jurisdictions, in some jurisdictions, we value restricted land like, you know, Crown reserves, those sorts of things, or parks or cemeteries or whatever. We value it on a cost approach on the basis that there is no open and active market. Therefore, it would be inappropriate to use a market approach. So we value it on what would it cost for us to acquire it. In other jurisdictions, and Victoria is one of these, you know, there is a general rule where the valuer general says, if it is a park, you discount it by 50% or 60%, or whatever the figure is. If it's a cemetery, you discount it by 90%, all those sorts of things. That has led to, you know, from my earliest days in the audit office, so I'm going back in my career, you know, 30 odd years ago, or thereabouts 35 years ago, when we first implemented accrual accounting in local government in Queensland, the number 1 issue on that day was how the hell do you value parkland and those sorts of, and it has been in a very emotional argument ever since, and it continues today. Hopefully, though, through the AASB project and the issue of ED320, we can now put all of that to rest, and that we will get consistent application across all the jurisdictions. The bad news, I suppose, for you guys is that this is a huge issue for Victoria. So the existing practice, and if you read the Valuer General or the DVG's guidance on this, they actually refer to it as market value as opposed to fair value. Because what they assume is that because it's land that you can't sell or you can't build assets on, there's an underlying assumption that that's not its highest and best use. It's restricted and that you can't sell it to someone. The AASB has said, well, in actual fact, no, its highest and best use is what you're actually using it for. And if you go and look at the IPSAS standards, so understand in Australia, when we moved to the IFRS standards in 2006, we applied IFRS standards across all 3 sectors. So private sector, public sector, and not-for-profit sector. However, we also included a range of what we call AUS paragraphs in the accounting standards, where we take some things from the IPSAS standards to apply specifically to the public sector. If you look at IPSAS 17, it specifically says that, which is the property, plant and equipment standard for IPSAS standards, it specifically says that whatever you're currently using the asset for is deemed to be its highest and best use. And that same requirement sits in AASB 13, AASB 116, sorry. So that's caused a lot of concern for people. But at the end of the day, the Victorian default up to this point has assumed that the current use of restricted land is not its highest and best use, because, you know, the restrictions placed on it in its current state, if you tried to sell it, no one would be interested in buying it. However, the basis of conclusion 151 clarifies this black and white, and this is consistent with what is in the IFRS 13 examples, in the illustrative examples. And what it says is, it's not about what the asset is now, it's about if you were to sell it, what restrictions would pass from the seller to the buyer. So for example, let's just say that I'm an airport or a port, and as part of that, I've got an environmental buffer around the zone, around the you know, my land holding, and it's got mangroves and all those sorts of things. The reality is, it doesn't matter who you are, you can't go and bulldoze the mangroves and fill them in. So that sort of restriction would pass from the seller to the buyer. Likewise, if I've got a block of land which is contaminated and I wanted to sell that block of land, I would either have to remove that contamination and then sell it, or whoever gets the land would have that contamination with it. Likewise, you know, the inherent characteristic of the land is its location, its size, whether it has an ocean view or whatever it is, that would pass from the seller to the buyer. But for most local governments, and I'm going to say 99.9% of transactions I've ever seen for a local government selling land that was previously park or road, the normal process is you convert it from, you know, community land into operational land, which puts it on like freehold title. And what councils normally do then is that they change the zoning to allow for improved use of the land, whether as residential or commercial or whatever. And they do that because as a knowledgeable seller, you have the power to maximize the return from the land that you're going to sell. So what they say is, because land is used as a parkland, typically what would happen is that if you were to sell that land, you would remove that restriction in order to maximize your return from the purchaser. Now, if that is the case, then that restriction should not be taken into account. And if you think about this another way, I live in Moreton Bay Regional Council in Queensland, and Moreton Bay, it's on the north side of Brisbane. So we take in Redcliffe all the way out. We've got Sanford out to Kilcoy. So we've got a mix of the former Redcliffe City Council, but also a large regional, you know, rural areas. And our council is very strong on green space buyback. So I've got, for example, the property across the creek from where I live, it went up for sale about 12 months ago. Council purchased it within 2 weeks for a record price to use it for no other purpose than koala habitat. There is another block of land about 1 kilometre down the road from me. It's a 15-hectare site. It was a single residential property at some point, and council has purchased that again to turn that into koala habitat. Now, the reality I always look back in terms of accounting, pure accounting. At the end of the day, there was a transaction. You know, they debited an asset and they credited cash in order to buy that asset. And what the accounting standard says is you have to calibrate your fair value to that transaction price. So if that land was purchased at a market value in competing with all other market participants, and it cost them a fortune, just because you now turn it into parkland does not mean that it has any less value. Because where do you write the asset off to? And we have this issue in New South Wales where they have been forced to, buy land to do certain things and then write them down and then charge that write down straight to the profit and loss account, which makes no sense whatsoever. So very clearly in terms of restricted land, if that restriction would pass or likely pass from the seller to the buyer, then you would take that into account. And if it would not pass from the seller to the buyer, you do not take it into account. Now, there's probably a few people sitting there with their jaws on the ground going, what do we do about that? But that's the reality. That's what the requirements are saying. So what that means is you would not be discounting assets that are restricted assets unless that same restriction would pass to a hypothetical buyer. And in our experience, that is very rare that would ever occur. So, your local governments, next time you do your revaluation, assuming that Victoria falls into line with this practice rather than maintaining their existing practices, I would expect that your land values are going to go through the roof. I see there's a question.
I have a couple of questions in the chat box. And just for those of you who've joined who didn't miss the very start, if you have any questions, feel free to just add them into the chat box and we can ask them through as the session progresses.
Yeah. So I see there's a question there on land under roads, and it's exactly the same. It is common for councils to acquire land because they want to put a road corridor through, and they might buy 3 properties. I'm just going to pull some figures out of nowhere, but let's just say they have to buy 3 properties totaling 10 hectares, but for the road corridor they only literally need 1 hectare that goes through the middle. Now, what the accounting standard says, and particularly in terms of ED320, is you calibrate to the transactional price, which is the 10 million bucks, whatever they paid, and that is the fair value. And just because you put a road over the top of it doesn't mean that the land is worth any less amount of money. So the way I look upon it is, under the accounting standards, you've either got to use market approach, income approach, or cost approach. You would only use market approach where there is an active and open market. So there's no active and open market for a road corridor. Therefore, you're compelled to use the cost approach. And the cost approach says, if I didn't own it and I had to go and get it, what would I pay for it? Well, blow me down, we've got market evidence that says we had to pay a full market price for that land, and therefore that's what it's worth. And its current use as land under roads is its highest and best use. So hopefully that answers that question. Sorry, I just see this question from George. Did they pay more than a developer or an up? No, they'd be paying market price. They'd be competing with other people for that market price. Sometimes when you resume land, you have to pay a premium, but that's not really part of the market price necessarily, but you would include it probably at the transactional price. If you never intend to sell a park, so there's a question there about, does it matter if you don't intend to sell a park? No, it doesn't. It's about a hypothetical sale. So the question is, hypothetically, if I've got some land and I would sell it, would those restrictions pass from the seller to the buyer? Not am I going to sell it? And that again, that's part of the issues with practices in some of the jurisdictions where the valuers have argued, well, you can never sell it, therefore it's got no value. But that's a market value as opposed to an accounting fair value, and different concept. Most land under roads is gifted to councils with no cost. At the end of the day, if you control it, it's an asset that has to be valued, and technically under the accounting standards, if you get an asset below fair value or at no cost, you must immediately recognise it at fair value. So you still need to value it. Okay, keep moving on. But again, look, any questions, just send them through the chat. And if I don't see it, certainly Fiona will tap me on the shoulder and say, someone wants to ask you a question. Now, this is probably the next one, which is going to cause the most angst, not only in Victoria, but right across Australia. I still see today, and I've even seen model statements coming out of the jurisdictions where they call the replacement cost of the movements rec the current replacement cost. Then they go less depreciation equals depreciated replacement cost. And that shows a complete lack of understanding of what the accounting standard is. You have to understand that when AASB 13 was implemented and adopted in 2013, it changed the definition and concept of what fair value was. It moved from the old, willing buyers and sellers to the new definition about, the exit price based on the key characteristics relevant to market participants at the valuation date. Now, it also changed it from an entity-specific value to a market-based value. So a completely different concept. Now, in doing so, they also removed depreciated replacement cost as an approach, and they replaced it with current replacement cost. So when you do your financial statements, technically, it depends on whether you do a gross or net disclosure method. Now, my experience is in Victoria, most councils do the net disclosure method. So you report your fair value less any subsequent depreciation or impairment, whereas most of the other jurisdictions do the gross disclosure method, where they report the gross replacement cost less accumulated depreciation equals your current replacement cost. So it depends on how you do your disclosures. But the main thing is, if you are doing a depreciated replacement cost approach, you are inconsistent or not consistent, or if you're like me, I'm an ex-auditor, so I tend to use the word non-compliant with AASB 13. There's obviously some grayness there. I'm not necessarily at the end of the scale, but I think there has to be some fairness in terms of interpretation. But at the end of the day, if you're basing your valuation on useful life or remaining useful life, then fundamentally you are flawed, and you'll be misstating your valuation. Now, if I just go back to that previous slide, I just got this big yellow box up here to say this is not a change. And I really got to stress this. If you have a revaluation which has been done, it's been done on a non-compliant DRC approach, then technically you are non-compliant with the existing accounting standard. And the reason is basis conclusion 173 and 174. And it says some stakeholders in the consultation period leading up to the development of ED320 asked the question that, should we be clarifying that adjustment from replacement cost down to current replacement cost is an adjustment for obsolescence, not an adjustment for depreciation. So I know even in your movements rec, you disclose it as depreciation if you're using gross disclosure method, but that's just a disclosure. The actual calculation of it is that it's an adjustment from replacement cost down to current replacement cost. And that adjustment is obsolescence. And the one through agenda, key aspects. Background. We looked at the key issues identified through the thing. We've got. I talked about restricted assets. And then I'm making the point about current replacement cost is not the same as DRC. So, for some reason, this is really playing up. Forgive me for this technology. It's so are you seeing the slides now, Fiona?
Yes, can see the slides.
Cool. Okay, cool. So in terms of this issue, BC 173 says specifically the question was asked about, is it obsolescence versus depreciation? And what they said was the accounting standard does not need to change. And the reason is because it's already black and white, where it says under B9, that where you use the cost approach, the adjustment is you calculate the replacement cost first, you then adjust for obsolescence, not depreciation. And B9 goes further to say that that adjustment for obsolescence is conceptually different and much broader than depreciation for financial reporting purposes. So there's no relationship whatsoever to getting down to fair value and depreciation expense. And if you think about it, you know, if you go and value something like a residential property or something at market value, there is no consideration given to the depreciation expense. The way the process works is you first determine your fair value. And specifically in BC 174, they say that the way you do that is that you must take into account the key characteristics relevant to market participants. And they are listed specifically in paragraph 11 as condition, location, and restrictions on the sale or use of the asset. Now, just in terms of restricted land, people are going to go, oh, it's saying you've got to adjust for restrictions, but only the restrictions that would pass from the seller to the buyer. That's the important thing there. And if you look at all the different accounting standards across the globe, whether it's IFRS, the existing IPSAS standards, IPSAS 17, the proposed IPSAS standards, which is the measurement standard and the infrastructure standard, as well as GASB in the US, they all have the same approach. They don't talk about adjusting for depreciation. They all talk about adjusting for obsolescence and condition. So this is a big issue. And unfortunately, I've got to say a lot of, you know, key bodies, whether that be local government departments, valuers general, auditors general, treasuries, unfortunately, over the time, they've all issued a whole range of guidance, which if you look back at that guidance versus what this requirement is, you might start to question whether that guidance was right. In government, change takes a long time, and we're paying the price for it now.
We just have a question from John, just wondering where there is no obsolescence, then the theoretical calculation of accumulated depreciation would suffice. Is that correct?
No, I'd say no. And the reason is because, so obsolescence is much more than just pure obsolescence. It's technical, functional, economic obsolescence. So paragraph 11 says you've got to adjust for condition, location, restrictions. If you think about how people buy assets, and if you look at IPSAS 17 as a really good example, it talks about using depreciated replacement cost approach based on condition, or using the restoration of costs method, which is how much would it cost to bring the asset back up to as new. And they're relatively consistent from a conceptual perspective. So if you're going to determine a fair value, you need to have some understanding, particularly of the condition of the asset. So I'm sorry about that one, but that'd be my quick response. You know, simple sounds great, but it's going to lead you down trouble in the long run with a few different things.
Thanks, David. Another question. Councils in Victoria have a performance measure of capital spend versus depreciation. How do you see this impacting these measures?
Yeah, look, I'll be the first to say that it's a common KPI across most of the jurisdictions. The trouble with it is that there is absolutely no relationship between depreciation expense, which is a non-cash estimate of the consumption of your service potential, and what your future renewal costs need to be. It is one of those things that at the time, it was a nice and simple thing to calculate. Does it make sense? Well, no, it doesn't. If you look at, I'm going to talk a little bit later about short life and long life parts of an asset. This is where there is some linkage. The short life part per the AASB is based around what your estimated renewal cost is. So if you're going to compare depreciation to your CapEx projections, the measure should not be depreciation expense. It should be the depreciation expense that relates to your short life part, which is an estimate of what your renewal cost should be. And if you go and look at, say, IPSAS reporting guidance number 1, which has been around for, I'm going to say 30 years, So RPG1 deals specifically with sustainability, and it makes the point right up front. There is no point comparing KPIs out of your financial statements, because your financial statements report your past history. It has nothing to do with what your future is. So they're more about qualitative disclosures that provide information about your sustainability, as opposed to, hardcore figures that come out of your financial statements. And then I'm going to say, and this is not new for people who know me, if I walk into a council and did an audit of your depreciation expense, I would suspect that I could probably find reason to qualify probably 70%, if not more, of the local governments, because the depreciation methodology really is not compliant with the AASBs. So what that means is that your underlying depreciation figure to start with is not reliable, therefore your KPI is unreliable. But the only way to prove that is to go and test it, I suppose.
And I think the issue there is that we have that prescribed, so the government prescribe what we need to use.
Yeah, I know. Unfortunately, you're stuck with it. Is it meaningful? No, but you're stuck with it for the time being, unless you can have a conversation with the department and the Auditor General to say, maybe this doesn't make sense. Maybe the measure is not really appropriate. And I know some of the Auditors General in different jurisdictions are looking at those KPIs. And I know that they are recognising that those KPIs don't necessarily make a lot of sense. But some KPIs are better than none, I suppose, is the way to look upon it. Look, if you're a fast-growing council on the Eastern Seaboard, then obviously, your future renewal costs aren't going to happen for 30 to 50, 60 years' time. Therefore, there is no reason why your depreciation expense should even come close to measuring how much your CapEx is at the moment. But in 30 or 40 years' time, your CapEx expenditure is going to be 30 years worth of accumulated depreciation. So why are you comparing 30 years of depreciation requirement to 1 year of depreciation expense? There's a mismatch. And the first thing you've got to understand is there is no relationship between depreciation expense and what your future funding needs are. They are completely different concepts and requirements. Okay, let's just keep going, and please, Fiona, just feel free to.
There is one more question. Sorry, Victoria uses the gross method for infrastructure, so therefore the written down value would be correct? ? And we just need to use the net method, our written down value, and consider obsolescence for the future disclosure.
I'm not sure I understand the question. So you're using gross disclosure method for your movements reconciliation note, but that's not what your model statements show in Victoria.
Yeah, we might take.
Sorry, yes, it is.
It is.
So our statements gross up. So you've got your gross replacement costs less your accumulated depreciation is your written down value.
Yep, cool. But your written down value is your fair value. So at the time of revaluation, it's your fair value. It is not based on depreciation expense. Under the accounting standard, it must be based on obsolescence and the key characteristics relevant to market participants. Once you've determined your fair value, the difference between your fair value and your gross is disclosed in your movements reconciliation as accumulated depreciation.
But so going forward at the moment, they've got a written down value, which is their fair value now, but going forward, that would become the consideration before obsolescence to come down to what would be the new fair value. They're going to need a starting point.
Yeah, the starting point is the replacement cost. So understand the timeline. The first thing you have to do is determine your fair value, and your fair value is your replacement cost less the adjustment for obsolescence based on the key characteristics relevant to market participants, being condition, location, restrictions, and that determines your fair value, which equals your carrying amount. In the financial statements at that point in time, the difference between replacement cost and fair value is reported as accumulated depreciation. If you look at the basis conclusions in ED320, there's even a specific one right at the end that deals with that issue that suggests that we should not call it accumulated depreciation, we should call it obsolescence. And the AASB's response to that was, well, there's nothing stopping anyone doing that if they wanted to do it. But 1 year later, assuming there's no further revaluation, let's just say that your gross was $100, your fair value at time of reval was 80, you would disclose accumulated of 20. 12 months later, let's assume depreciation expense was $1. You would show replacement cost of 100, written down value of 79, and accumulated depreciation of 21. I hope that makes sense.
Sorry, you're just blowing my mind. I'm just trying to get my head around it. So
yeah,
I'll have to sit with it.
No, that's all right. And I said this will be challenging. The key point here is to get from replacement cost down to fair value is not depreciation expense. It is an adjustment for obsolescence as set out in paragraph B9 of AASB 13. It has got absolutely nothing to do with depreciation expense. You have to determine your fair value first, based on, from a market-based approach, based on the key characteristics relevant to market participants. They are specifically listed as condition, location, restrictions. There is absolutely no mention in AASB 13 of useful life or depreciation expense or remaining useful life, other than the statement that the adjustment for obsolescence is conceptually different and much broader and not the same as an adjustment for depreciation expense. And I know, look, I'll be honest and say, when the first time someone pointed that out to me and I looked at it, and it probably took me 2 years to really process it and understand what it meant. Because we've all been brought up using a DRC approach. And particularly in jurisdictions like Victoria, it's pretty much just been mandated. That's how you do it. And no one's bothered to say, but is it really how we're supposed to do it? So ED320 should serve as that little poker to say, oh, maybe we need to change something here. Okay. I'll just say there's another question here from George. Our practice has been to apply a notional depreciation for monthly reporting purposes, back it out at year end and assess the fair value and process the change in value. No, so depreciation is not dead, trust me. Again, you've got to separate conceptually the revaluation of an asset has got absolutely nothing to do with depreciation expense. You revalue an asset, you then depreciate it through your P&L to record the consumption of its service potential. And if you then do another revaluation at the end of the year, the net adjustment will be an asset revaluation reserve adjustment. So let's just say you start at $100, depreciate down to 90 through depreciation expense. At the end of the year, you reassess your fair value, it goes up to 105. You will have depreciation expense in your statements of $10, and you'll have a $15 asset revaluation reserve adjustment. Is this another form of impairment? I'm not sure I understand the question, Dennis.
So I guess years ago we did some work within the education portfolio, and we impaired. So you talk about market conditions, which is value and use, I think the term is, and then we wrote off. We impaired the value of the school building that wasn't used because student numbers were dwindling. Would that be?
Okay, that's obsolescence. Yes. Yep.
So in that form, if we're going to make an asset not as valuable as what it used to because of market conditions or value in use, then it would be an adjustment as an impairment. And thus I understand why you wouldn't adjust depreciation. Depreciation would be adjusted by the use, the actual use of the asset, rather than impairment, which is the writing down of the asset.
It's not, but I am going to cover that later.
Okay, great. Thank you.
So if I don't cover it properly, give Fiona a poke and say, oh, Dave's forgotten about me. So
yeah, no worries. Thanks.
Cool. Okay. So, and look, I said this was going to be challenging, and it is. The other thing is BC 175, method of depreciation. And this is another big one. And again, yellow box, this is not a change. AASB in ED320 make the point that you know, the depreciation requirements have not changed and don't need to change. So this is a national issue. I would dare say it's an international issue. Excuse me. And despite AASB 116 paragraph 60, which talks about the depreciation method has to match the pattern of consumption. And also for people who've been around as long as I have, back in 1997, we used to have an accounting standard called depreciation, AAS4. So this is pre-adoption of the IFRS standards. And in that standard, what it used to say was and the words were, you should use a method which matches the pattern of consumption. But if you can't, use straight line because it's simple. Now, when we moved, so in 1997, that accounting standard was changed. The word should was changed with the word must. So you must use a method that matches the pattern of consumption. And any reference to using straight lines of default was removed. Now, the issue we've got here is in some jurisdictions, and Victoria is one of these, it's pretty much mandated that you have to use a straight line approach. And the reason that's been mandated is because it's nice and simple and easy to understand. The trouble is it gets in the way of actually accurate financial reporting, and it gets in the way of good asset management because you're producing figures that don't really reflect what's actually going on. So the approach can result in misstatement. I've just said here, you know, based on what's in ED320, hopefully the little lights are turning on and people in high places are sitting back going, maybe we need to rethink about what our prescribed requirement is and what needs to be done. So BC 175, again, this came out of stakeholders asking the question about applying straight line. Should they be able to say it's what you must use? And the AASB were quite explicit in this and said, well, no, you don't use straight line because you have to use a method which matches the pattern of consumption of your economic benefits. And also understand that it's the requirement of the entity to determine how they expect their future economic benefit to be consumed. It is inappropriate for anyone else or the auditor to tell you what your accounting policy should be. So, and I know there are lots of people out there who will say, oh no, we think that, you know, as we provide the same service day in, day out, the consumption of that service potential should be the same. But it's not a question about what the service is. It's a question about how that future economic benefit is being consumed. So for example, if I've got a road, if you talk to any main roads departments, they will tell you that roads are consumed by the equivalent standard axles that pass over the road. And as we know, the measure of ESAs increases incrementally because we have greater population, more trucks and cars, and more heavier trucks. So the road is still providing the same service, but the road is being consumed at an ever increasing rate. And the trouble we've got here is, you know, if your valuation is based on a measure of the true level of remaining service potential, and your depreciation method doesn't match that same pattern, then you get misstatement within your figures. So I guess what I'm saying here is, and look, I'll be honest and say for our valuations that we do valuations for local governments, we do everything a straight line now. We don't think it's necessarily right, but at the end of the day, we're sick of banging our head against a brick wall. And if clients want straight line, we deliver straight line. It's as simple as that. And most of them do it because they've been told they've got to do straight line. But technically under the accounting standard, you shouldn't adopt it because it's simple. That was removed in 1997. AASB 116 is quite explicit. You have to use a method which matches your expected pattern of consumption of future economic benefit. What that means is, you know, if you expect that you're going to consume 10% of your service potential over the next 5 years and 20% over the following 5 years, then your depreciation method should match that same pattern. So whatever profile you're using to do your valuations, the same profile should be used for valuation. In terms of profiles, There's lots and lots of different profiles. Like I said before, our default is to use the old straight line profile for no other reason than it's easier to go with the flow rather than have a theoretical debate with 15 different auditors every year. However, you talk to anyone who's actually physically managing assets and they will tell you it is not straight line, it is something different. More often than not, it's an increasing curve. The main thing is just need to make sure that whatever you're using to do your depreciation and doing your obsolescence is the same profile. I see a couple of little comments there. I won't say who they are, but yes, we got sick of banging our head against a wall too, and auditors don't accept that though. Well, the issue here, I suppose, is the AASB has now issued ED320. They have spelled out in black and white that the depreciation method has to match the pattern of consumption. So hopefully that some of the treasuries and local government departments and auditors general will sit back and go, well, maybe we've got to change our point on that. And at the end of the day, if you really want to stick your heels in, you can argue whatever the pattern is, and it's not for them to say, I just disagree. They've actually got to say, well, it doesn't comply with the standard, and they've got to find out how it doesn't comply. The other thing is, and someone else has pointed this out, the non-linear profiles allows you full integration with your asset management framework. And, every jurisdiction, the auditors general are going on about the asset accounting doesn't integrate to the asset management. Well, the simple answer is, well, of course it bloody can't if you're going to apply assumptions that don't reflect the asset management reality. So, maybe it's time to rethink. Just to demonstrate here, if you look at this black line, and I've put, look, this is just a curve I've just drawn for the sake of drawing the curve. If this reflects how your asset is being consumed, and what I will say is most asset managers with long-lived assets will tell you that as an asset ages and deteriorates, you tend to spend more and more on maintenance. You also, the rate of degradation increases, therefore the cost to bring the asset back to as new increases incrementally. And the other thing is that particularly for very long-lived assets, as they get towards the end of their life, the impact of general obsolescence increases incrementally. So the consequence is you end up with a curve which, obviously speeds up towards the end of the life. If that represents the assessment of fair value based on the key characteristics relevant to market participants, and you apply a depreciation method which is different than that profile, then you're going to end up with different results. So the typical process, a lot of systems will apply the yellow line, the gross, I've assumed a zero residual, down to zero over the total asset useful life. That obviously gives you a different depreciation calculation than if you apply the remaining, the carrying amount less residual over the remaining useful life, or the more technically correct method, which is making sure that the depreciation matches the method and pattern of consumption. So you can see you can get three completely different results. And that's why it's absolutely critical that your valuation profile and your depreciation profile match as required by AASB 116 paragraph 60. In terms of match pattern, just to demonstrate, if your expectation is over 10 years, I'm going to lose 20% of value, then your depreciation expense should depreciate 2% per annum to match that pattern of consumption. That's the technical side of the accounting standards. Okay, I just see there's a comment there. Someone's got, most auditors insist that when you want to replace an asset, then accelerate the depreciation at that point. I guess the quick answer to that is, well, yes and no, because one of the requirements of the accounting standard is at least at the end of every year, you have to reassess not only whether your carrying amount reflects your fair value, but you also have to assess your useful life and other depreciation assumptions. Now, there's a requirement for local governments in Victoria that you must maintain your asset valuations regularly, and you must ensure that your carrying amount reflects your fair value. Remembering too that AASB 136, the requirements of that, the impairment standard, for the last 3 years, I'm going to say 3.5 years, no longer apply to specialised public sector assets. And the reason for that was because you're supposed to be keeping your fair value valuations up to date and regularly doing them. Now, normal practice would be you do a comprehensive every 3 years, and then in the years in between, you would do a desktop update. Now, if something happens to an asset where you previously said it's in a pretty good condition and we're going to keep it going for a long time, and suddenly, you know, council decides that they're going to completely demolish the showground and build a new showground, as a consequence of that, the useful life of that asset reduces significantly. Rather than depreciating that existing carrying amount down to nil over that, 3 years, you first of all, you have to adjust your carrying amount down to its new fair value. So your fair value might go from $10 million down to $500,000, which you would then depreciate that over the remaining 2 years. So you need to make sure you get everything in the right process. There's a question here. Is it known if many councils have asset management systems that can handle this? I'm going to say there are some that have made an attempt to do to that level. And I'll show you a system later that can do it. But, some can, most can't. But there are ways around it, and I'll probably talk about how you deal with that to get around it. And also understand that financial reporting runs through your financial system, not your asset management system. And it's absolutely critical that you are not doing valuation with live data. It must be done external to your, whatever your ERP or asset management system is, because you don't want figures changing because you've changed assumptions. You always do your valuation external. And then once everyone's happy, audit's ticked it, that's when you would process or upload the adjusted figures. Okay. And this is probably another big thing. Again, this is not a change. And a couple of the comments that came through before, I forgot to make this point. When you do depreciation, and the accounting standard talks about every year reviewing what your useful life is, it is not talking about the period from here down to here. In asset management terms, that's the useful life. In asset accounting terms, the useful life is the point from where we are now to the end of the economic life. It's the remaining useful life in accounting terms is useful life. And that gets really confused. So it's a national issue. Most finance systems incorrectly base it on the gross less residual value over the useful life. But technically, that's incorrect. BC 176 clarifies that the accounting standards already have provided guidance on this. It's in IAS 8. So IAS 8 is International Accounting Standard 8, which AASB 108 is based on. There is an example in there, example 3, which clarifies that if you're using straight line, even they say if you're using straight line as opposed to other depreciation methods, the calculation of depreciation expense is your carrying amount less residual divided by your remaining useful life. So the example 3 in there, you'll see that we've got 25,000 cost units, less depreciation, giving us a written down value of 11,000. They then come and revalue that asset. Based on that revaluation, the new value, this is net disclosure method, 17,000. We've got a 3,000 residual value, meaning we've got a depreciable amount of 14,000. The average remaining useful life is now 7. So 14,000 divided by 7 gives us our depreciation expense of 2,000. And the issue here is that a lot of the finance systems have deliberately been set up using that formula rather than the technically correct formula. The other side of it, I suppose, which is a bit of a saving, is that if you've been using a straight line profile anyway, the figures are going to come out the same. But if you haven't been using a straight line profile, then you will have some impacts. Oh, okay, sorry, I can see that you can't see where I'm pointing. I'm sorry for that. I don't know how I could possibly fix that. In other words, seems like the condition is the key for all of this, and it's important that the condition of the assets team generate also take into account intervention, which is essentially the business assessment of end of service potential. Would this be a correct assumption? And the quick answer is absolutely. Your asset accounting, your depreciation assumptions, your valuation must reflect your asset management reality. When I get into methodology a little bit later, what you'll see is how that works and why it needs to be done that way. BC 176, again, depreciation based on carrying amount, not the gross. And this is a bit of a hidden trip, I guess, a trap. Finance systems will need to change, no doubt about that. However, probably one of the biggest issues is that in May 2015, the AASB issued what they call the residual value decision. Now, it came out of work that a number of different practitioners were working on and asset management people were working on. And they were trying to, and I was one of them, we were trying to integrate asset accounting with asset management. And the argument put forward was, if I've got for sake of the argument, I've got a road pavement and worth $100, and every 80 years or thereabouts, I expect to come along and do some pavement rehabilitation at a cost of $40. It was argued that all I'm really doing is losing $40 of value over those 80 years. And if that's the case, why am I depreciating the other $60 of the pavement? Now, the AASB looked at it. As a consequence of that, they said, well, technically, the bit that we didn't want to depreciate, whilst you're not spending any money replacing it, at the end of the day, it did not meet the definition of residual value being non-depreciable. And the reason was because residual value by definition is a proceed upon sale or disposal. And because you weren't disposing of that asset, it can't be residual value. However, what they then said was, if that was the fact, what that demonstrates is that you have two different parts with two different useful lives. And as per AASB 116, each part that has a different useful life has to be depreciated separately. So in the papers that the AASB put out about that, they referred to those parts as the short life part or renewal part and the long life part or recyclable part. So just catching on something I said earlier in the presentation around about depreciation expense. The short life part represents what your estimated renewal costs are. So if you are going to do some KPIs and try and hook up depreciation to what your future CapEx projections are, it should be based on the short life part, which is the bit that you're going to replace and renew. The long life part, you are not renewing unless you get an asset where you get to the ultimate end of life and then you choose to replace it. But quite often you never replace those assets anyway, not with the same asset, maybe something completely different. So from an accounting standard perspective, what they're saying is, I've got an asset, I've split it into different components. So this could be a road, surface, pavement, formation. It could be a building, substructure, structure, roof, fit out, floor coverings, mechanical services, hydraulic services, electrical services, etc. And I need to consider what my asset management renewal treatment is most likely to be. So if this was floor coverings, it would probably be 100% short life, because when I come and rip up and replace the floor tiles or the carpet or the vinyl, the cost of replacement is the same cost as building brand new. And therefore there is no long life part. But if this is a road pavement, the cost of my pavement renewal is going to be less than the cost of my overall pavement. Therefore, I have a short life part and a long life part. One of the other important parts of the decision is that this short life part and long life part do not have to be physically identifiable. Okay, so I'll give you a good example. a lot of councils now tend to reline pipes using underground technology where they put a heated sleeve pump it up the pipe, and then it cures and provides a structural surface and all the rest without needing to rip up the pipe. Now, the reason they do that is because the cost of that renewal, the short life part, is significantly less than the cost of the overriding pipe. So if I'm going to put a hot sleeve up a pipe to reline it, I might get 80 years out of that sleeve. But as a consequence of that, my overall pipe life might increase to 180 years or 200 years. And therefore, I have the estimated cost of my relining should be depreciated over the 80 years. And the balance of that cost should be depreciated over, say, the 200 years. And that's what the decision is about. Now, the consequence of that, because depreciation is based on the carrying amount of each part, what that means is that when you get a valuation done, you need to have a fair value delivered for each part of each component of each asset. And I know this sounds like a lot of bloody work, but fundamentally it's not. It's just about methodology, and it takes no longer to do that valuation and no greater cost than doing it how you've always had it done. Okay, so there are the basis conclusions. I just want to touch on now some of the other aspects of this ED320. Someone's got a question: short life, long life parts, isn't this componentization? And the short answer is no. Componentization is an engineering term. It is not in the accounting standards. The reason we split assets into components is because they tend to reflect the different parts that you manage separately and are what's set up in your asset management system. So if I look at a building, I'll typically have a roof as a separate component. Or if I'm looking at a road, I'll have the surface versus the pavement versus the formation. They're the components. If I look at, say, a road pavement, there are, potentially 3 or 4 different renewal treatments that we may adopt as typical practice, depending upon our particular circumstance and all the rest of it. So depending upon which treatment that we apply, it will have different intervention points, it will have different costs, and therefore the short life, long life split will be different. So yeah, don't confuse componentization with disaggregation into parts. It's terminology. And again, we've been, different professional bodies, shall we say, have promoted certain practices for a long time. And it's just been assumed that whatever they've put out is correct, when in actual fact, it's engineers or whoever trying to be accountants and don't necessarily get it 100% right. And it just gets embedded within the culture. This should be the wake-up call to say it's time to do things a little bit different. Okay, so in terms of market participant assumptions, this is covered in paragraph F4 of ED320. And it basically says, if you're selling an identical asset and there's observable evidence, then you use that observable evidence. So in other words, if I've got a residential property or a truck or a car or a piece of plant and equipment which is traded in an open and active market, there's observable evidence of identical assets, and therefore I use a market approach. If I don't have that, however, I should use the pricing assumptions that other market participants would take into account. So for example, condition, location, restrictions. They're the important things. And if you think about, how you go and buy houses, for example, people will go and look at different houses. And normally what they do is they look at, say, 2 or 3 houses that they think they potentially want to buy, and then they'll start doing the sums. But what is it that I need to do? What's it going to cost me to give me what it is that I want? Do I want to put a pool in? Do I need to fix the air conditioning? Do I need to rip out and replace the kitchen? It's all about condition and the cost to bring back to new, or the cost that you need to spend. What they then say is that if all relevant information is available, then you need to use that assumption. If it's not, then you use your own assumptions, and you just need to document that and provide some sort of evidence as to, under AASB 13 and your disclosures, you're supposed to provide information about how you validated your assumptions for reasonableness. So what evidence did you use, or what's the basis of coming up with those assumptions? Now, highest and best use, this again is what I talked about earlier about restricted land. This is a huge divergence for traditional practices in Victoria. The assumption in Victoria, from my understanding at least, has always been that if you've got parkland or cemetery land or something like that, it was assumed that it was not the highest and best use, and therefore the land was discounted. Whereas the AASB is very clearly saying, if it's a public sector asset, whatever you're using in it is its highest and best use. And the quick example of that is, if you weren't providing it, but another council had to come in and provide that service, would they be likely to also invest in that same asset? So if you've got a park, well, the simple answer is, well, yes. Therefore, it's at its highest and best use. And that presumption can only be rebutted when the appropriate level of the entity's management has committed to a plan to locate a buyer of the asset or transfer the asset to another entity, or to use that asset in an alternative purpose. Now, I know the AASB is looking at this particular paragraph. This may change, but at the end of the day, what it comes back to is, unless there is some indications that you're going to use it for some other purpose or you're going to sell it, it's presumed that its current use is its highest and best use, and therefore you would not apply any discount. I can see a question here. What then happens to the CSO? And the simple answer, this is one of my favorite questions. I'm going back 30 years. Actually, it'd be 25 years. We had a Valuers General's meeting in Queensland, and I was there as part of the Queensland Audit Office to provide some insight. And we were talking about valuation of state land and parks and those sorts of things. At the beginning of the meeting, there were multiple different views on how you would do that. By the end of the meeting, there were two views. One was you value it at full, at replacement cost, at full market value. The other was that you have to discount it because part of it is a community service obligation. Now, the problem we've got here is that a community service obligation, by definition, is service potential. And you're supposed to value all the service potential embodied within the asset. So the simple answer is CSO, there should be no adjustment for CSO because, again, the value of restricted land is the value which excludes any restrictions that would not pass from the seller to the buyer. And in which case, if you're moving it from a local government to a private seller, they are not going to be using it as a community service obligation. They're going to be developing it or doing something with it. So CSO itself, conceptually, you might argue it exists, but it has no value in terms of an adjustment to the valuation. Okay, so let's get into the cost approach, and let's be honest here and say, 97% of all your assets are valued under the cost approach anyway, whether they are specialised buildings, roads, water, sewer, marine assets, open space assets, all that sort of stuff. It is a big issue for Victoria. I know in the past, terms like brownfield and greenfield have been used in Victoria. I know at one stage they were even embedded within your prescribed requirements. I'm not sure if they still are now. Maybe someone can correct me there. I think they're gone now. But the reality is those terms are engineering terms. They do not relate to the accounting standards, and they should not be used, and they do not reflect replacement cost as per AASB 116 or AASB 13. Just bear with me. I see there's a question here. What are your views on zoning impacts? i.e. land is zoned public use? Again, it comes back to, just because it's zoned public use, you have to consider that if you hypothetically were to sell that land or divest yourself of that land, would that zoned public use transfer from the seller to the buyer? Well, if it would, then you take it into account. If you wouldn't, which is more than likely, then it has no impact on the valuation and no discount allocated to it. Okay. Now, also in Victoria, I know that I did some work with one of the larger councils in Victoria. I've been doing some work with them the last couple of years. And last year, when we were getting the valuations for their roads done, we had put a figure in there for the recognition of the road formation because they had never done it before. And as part of that, we had some discussions with Vargo around it. And Vargo said, "What are you putting it in for?" And we said, "Well, because you have to." And they said, "Well, we're not sure any other council's ever done that." I can tell you in every other jurisdiction in Australia, road formation is part of the valuation of the road. Non-depreciable normally, but it's still part of the replacement cost of that road. And I think the issue for Victoria flows from past practices where we talked about applying brownfields in certain approaches and greenfields in certain approaches. The issue here is, for this particular council, we knew that formation had not been previously recognised. And based on Vargo's guidance, we wrote it down to 0 so that it wasn't a material change on previous valuations, and the issue was to be addressed at a sector level by Vargo over the following 12 months or whatever. I had a discussion with Vargo probably, I'm going to say 8 months ago on this one. This is when Sanchu was there rather than Travis, and they wanted some further explanation as to what the impact was. And at the end of the day, it came down to 2 things. If you have recognised formation, but you've included it as part of the value of your pavement, so if you look at your model statements, you have a section there for surface and pavement, but there's no separate section there for formation. So if you have included formation cost as part of your pavement, then you've got an issue because your depreciation expense is wrong because you are depreciating a non-depreciable amount, and it's a significant amount. The alternative is that you have excluded formation and your pavement is okay, so your depreciation is all right, but then your valuation is wrong because you've excluded formation. So I think councils need to really work through this one to understand, have they got formation in there, yes or no? And are they depreciating it, yes or no? I'm just going to flip back to a question that's come through. Going back to highest and best use, if land is being developed for residential purposes by a local council, ultimately to be sold, the value of land will be based on fair value. Assume the residential units are being sold, not in the year constructed, but in the next financial year. Given that conditions of rebuttal fulfilled, I would agree, but I would also add, you're not valuing it under AASB 116, you'd be valuing it under AASB 5 assets held for sale, in which case they'd be in a separate section in the financial statements, and you'd be valuing it on the recoverable amount, which is what you expect to receive from the sale of it. Okay, so application of the cost approach, covered by paragraphs F11 to F12. Now, I've got to stress here, this is about how to calculate the gross replacement cost. It is not about how to calculate the current replacement cost. So we're only talking about how you determine gross replacement cost. And again, this was covered in the tentative decisions the AASB issued in, 2019. So this is not new. You assume that the asset will be replaced in the same location. You also assume that the asset does not presently exist, but would be replaced with the replacement cost, incorporating all costs intrinsically linked to acquiring or constructing the subject asset at the measurement date. Now, obviously, that's based on what the modern equivalent would be, adjusting for the difference in utility. But assuming it's a road, it's going to be a like for like. You have to adjust the replacement costs for the difference in utility, and which deals with service capacity and standard of finish between the existing asset and the reference asset. Now, this is where it can get a little bit vague in that, you know, just because I've got a school building or a community hall, you know, the style of community hall that was built 40 years ago is completely different than the style and shall we say, look and feel of a community hall that's built today. So if you've got an old crappy timber building, you can't base it on a direct cost comparison with the cost of a new, double brick with, air conditioning and all the rest of it. You have to compare the utility of what you've got with what the modern equivalent would be and make an adjustment for that difference in utility. In determining the replacement cost, you also have to include one-off costs. So going back to my previous talk about road formation, it used to be argued that, once you've built a road and done the formation, you never have to incur that cost ever again. So why would you value it? Well, this is confirming that those costs, if they would be incurred as part of the asset, they represent service potential and they need to be brought to account. You also have to apply judgment with respect to the cost of removal and disposal of any unwanted existing structures and any disruption costs that would hypothetically be incurred. Now, I've got to make a point here. The removal and disposal of unwanted existing structures excludes any structures that are controlled by you already, because you can't have double counting. And the other thing is that technically under AASB 116, if I've got a road and let's just say I've got a road and under that road I've got a pipe and I'm going to replace that pipe and I'm going to incur costs to rip up the road and then restore the road later, that road is already in your books. Technically, the act of ripping it up, you have to technically write that off to the P&L account as a loss on disposal, and then you would capitalize the new work to replace it. So if you own the road, you exclude that cost. If the road belongs to Main Roads, you include it because it belongs to someone else. In the real world, is it such a big issue? Probably not. And there are ways of dealing with it. I've got a council in Western Australia that talked to me the other day about this. And what they, sorry, South Australia, it wasn't Western Australia, South Australia. Traditionally, what they had done included in their replacement costs were costs that should not have been included under AASB 13. But to integrate to their asset management planning, what we did is that we worked out what the full replacement cost should be under the standard. We then took account of those additional costs that were part of the actual asset management placer that shouldn't be in there, and we used them to determine the split between short life and long life, so that the short life part represented their estimated renewal cost, which included costs that should not have been included, but the overall replacement cost excluded them in terms of the overall figure. If that makes sense, it's probably a bit round. I need to draw it to explain it, but just need to be very careful that you're not including costs that should not be there. And in determining those costs, you also need to think about the costs necessarily incurred in the context of your normal mode of replacement. You can't just assume that you're going to do it in the cheapest possible way because you're trying to reduce your depreciation expense figures. If you're doing work on roads in CBD, as a consequence of that, you've got to have all this extra safety, stop-go lights, working at night, all those sorts of things. That's the cost that you need to base your replacement cost on. So it needs to reflect the market reality. I've got a question here. What happens to service relocations of non-council assets such as water board assets, Telstra, NBN? Again, those costs need to be included in your replacement cost because they're assets that do not belong to council, and they would necessarily be incurred, and they classify as removal and disposal and replacement of unwanted existing structures. One of the good examples I use is many years ago, there was a dam upgrade in Queensland. I was in the audit office at the time, and we were looking at, well, what costs should be included in that. So they upgraded the dam wall. As a consequence of lifting the spillway, there was a range of assets that belonged to different entities that they spent about $30 million on replacing. So there were things like schools, roads, power lines, all those sorts of things. Those costs were necessarily incurred, so therefore had to be capitalized under the project. The question then was, when you come to revaluation, should those costs be included or not? And the answer, I suppose, is, well, yes, they should. The trouble is 20 or 30 years down the track, does anyone remember what those costs were, and how would you calculate them now? And I think this is where pragmatism comes into it. You probably say, you know, while it's fresh in the memory, maybe up to 10 years later, maybe you include them. If it gets to a point where if you excluded it, you're not going to have a revaluation decrement, then maybe it's appropriate that you might decide not to include them anymore on the basis that they can't be reliably measured. But that's a discussion you have with the auditors. Now, there was a question earlier about obsolescence versus, I think we talked about impairment, but it really was about obsolescence. So this is an example where I've got a school, I've got capacity to handle 500 students, but I've only got 100 enrolled in students. And the question was, is this really an impairment? Well, it's not. It potentially could be an obsolescence adjustment to the replacement cost. So if you decide that that's underservicing, if you want to call it that, or overcapacity is a temporary thing, then that is not permanent obsolescence, and therefore you would still value the school based on the requirement to have 500 students. So you might say, for example, we've only got 100 students now, but in another 15 years, we're expecting exponential growth in the population, and therefore we will once again need to have a school that can handle 500 students. If, however, you say, we've only got 100, we'll only ever need room for 100, therefore we have excess capacity of 400, then you would need to adjust your replacement cost down to reflect that excess capacity, and that's obsolescence. So that's an adjustment to the replacement cost, which in turn would impact both your fair value and your depreciation expense. I've got another question here. The next question is then, where you do not have the cost, relocation or non-council, then it skews the unit rate. So I'm not quite sure I understand the question, John, in that if you've had to relocate it and pay for it, then you do have the cost. But if you're not paying for it, then that's not part of your cost, I guess, is probably the simple answer. If you're paying for it or you don't pay for it, is going to be the important thing. It's what cost you would normally incur. And this is where the evidence is, you should use actual project costs, because under AASB 13, you have to maximize the use of observable evidence. And this is where sometimes, particularly the engineers, I don't want to trash the engineers, they do great work, but sometimes they like to use first principles calculations of theoretically what something would cost, whereas the accounting standard says, no, you've got to use market-based evidence of what it actually costs. Therefore, you should go back and analyze projects for actual costs. Another question here, will a repurposing of the building usage affect valuation? The short answer is potentially, because it comes back to, you know, what are you using the building for and what are you going to use it for going forward? So, you know, if I've got a building that I've been using for some purpose, like I don't know, a healthcare centre or something, and for whatever reason that service has now been taken over by the state government, God, we could only hope, and I have no longer any use for that building, but rather than having it sit there doing nothing, I've decided to use, you know, a quarter of the building as a storeroom, and the rest and the other 3/4 of the building are just vacant and will never be used. That would be an example where I've got overcapacity, which is obsolescence. But you really got to consider, you know, it's one of those ones where you've got to provide professional judgment, and there needs to be a bit of analysis taken into it to work out where things are at. Okay, so let's get on to the home stretch now. So what needs to be done? And I guess, you know, for the assets valued at a market or income approach, obviously you need to determine the market value. Now, I suspect from my experience in other jurisdictions, as well as my experience in Victoria, that a lot of valuers have, when they've done market valuations or income approach valuations, all they've ever done is come up and said the building is worth X dollars. They have not further split the asset into components and then further split it into parts. The trouble is that to comply with the requirements of AASB 116 and to comply with AASB residual value decision in May 2015. Technically, you have to split that asset into the different parts that have a different useful life and depreciate them separately. So what that means is you have to allocate that market value across each of those parts, determine what their remaining useful life is, and then based on that, calculate what your depreciation expense is. Now, I've got to stress here, in the AASB's residual value decision, what they also said was it's okay to use a blended approach to depreciation. Now, what that means is you can't just say, I've got a building, I'm going to say at the whole of building levels, a residential house, it's got 40-year remaining useful life. What it means is you should be assessing for each of the components of that building, so the structure, the roof, the fit out, the floor coverings, the different services, what condition they're in. Based on that, determine a remaining useful life for the short life part, long life part. But then you might add them together to get a weighted average useful life and RUL for each of those components. If I'm looking at the cost approach, so I'll just look at another question here. My issue was, say you do a road A and you have to relocate assets, do a road B, no assets to relocate. If you compare the two unit rates, they are different. The valuation purposes, then when do you draw the line on what to use? That's a really good question. And the reality is, it is absolutely essential that you develop an appropriate asset hierarchy that reflects instances where you're going to apply different unit rates. So in terms of what does it cost you? If you have an asset which is going to cost you a different cost, a different unit rate, or it's going to have a different useful life, or it's going to have a different renewal treatment regime, as in different treatment, different timing, then it's absolutely essential that those different assets are recognised in different asset hierarchies so that you can apply the appropriate assumptions. And if you're not going to do that, not only will your accounting be limited, but your asset management planning and modelling is also going to be extremely limited. And I think we need to recognise that, when we first implemented accrual accounting, I'm not sure for Victoria when that happened, but I know in Queensland it was the mid-1990s for local government, 1993. It was all new to us. And what we did is we did our best. We came up with some pretty basic hierarchies that we said, like roads, for example, or let's split them into, local, collector, distributor, those sorts of things. And we went and applied relevant assumptions. Then we got a bit smarter and said, oh, well, some of them, they got asphalt, some have got chip seal, some are concrete. They're going to have different useful lives. Let's apply different useful lives to that. But we're a bit more sophisticated now in that some roads will be in a particular environment. It might be the CBD versus a rural area, maybe versus a particular suburb. Different suburbs, for whatever reason, may have different useful life expectations. It might be because of the impact of they're near the ocean versus they're on top of a mountain. It might be because they're on a route or near a route where there's lots of trucks and that who damage the roads more than others. So fundamental of asset management, if you have assets that are going to require a different cost, useful life or treatment regime, you provide them with separate hierarchies. And those same hierarchies should be what's used to drive your asset accounting valuations and depreciation assumptions. Hopefully that makes sense. And look, at any time, if anyone wants to talk to me later, you're more than free to email me or phone me. I'll, more than happy to answer any of your questions afterwards. So in terms of the cost approach, so how should it be done? And I guess the first thing is, first you have to determine the replacement cost correctly, based on the AASB's decision. So not greenfield, not brownfield. You have to incorporate all the costs that would be necessarily incurred. You have to assume that the asset doesn't presently exist, but it would be replaced in the same location, all those things. You then need to split it into components. And I say that because, this is how asset management systems are set up, because every component tends to be managed independently of the other component. So you've worked out what your replacement costs. Once you've done that, you then need to split your components into short life and long life parts based on the estimated cost of renewal versus the balance of the value of the component. And whilst that sounds complex, in reality, it's pretty easy to do. You just need to, walk down the corridor or to the building next door, get your asset managers or engineers in the room with you, have a conversation about accounting standards, and understand what the cost is to build new asset. And when they come to renew assets, what does that cost and how often do they have to do it typically? And they're going to say, oh, well, it depends on the road, it depends what's wrong with it. And there is no hard and fast rule. But you got to put things in perspective. We are talking about basically a single figure that ends up in your financial statements that reflects your entire, asset class portfolio. So you got to get a bit beyond it and just say, look, I don't want to know about the exceptions. I just want to know what typically happens. And once you get down to that, the determination of short life and long life normally doesn't take too much to work out. Once you've done that, so this little purple line that I've got here, the valuation date, I'm assuming this is when I'm coming along and doing my valuation. Now, for sake of the argument, I've drawn some curves here as valuation profiles. As I said before, we tend to default to straight line for no other reason than it's easier than trying to argue what the profile should be. But for sake of the argument, I've just drawn some curves here. At that point, I need to determine the fair value for each based on obsolescence, condition, location, and restrictions. So if you think about this short life part, the key driver of this is the bit that I'm going to renew. So the key driver of how I determine the value of that is going to be the asset condition or the component condition. Whereas for the long life part, this is the bit that I'm not going to physically spend money on to replace necessarily. I mean, obviously here, I'm going to come and do some pavement rehabilitation at this point, and therefore I've got to replace my entire surface, which is sitting on top. So the key driver for this long life part tends to be just general obsolescence, in which case you probably look at the relative age of the asset and how long you think it's going to last in the long term. Now, having said that, that doesn't mean apply a straight line necessarily. I've specifically used a pavement here as a really good example. If I come along at this point in time, if I'm going to argue that my road formation lasts forever, has an indefinite life and therefore not depreciated, and this long life part of my pavement represents the part of the pavement that I'm never going to physically touch and spend money on, then why the hell would I argue that its consumption is a straight line over 200 years or something, when the reality is the value remaining in that pavement is extremely high. So it may be like 95%. So this is where you've got to pick what's the profile that you apply to determine what to do. And then once you've done that, then you have to depreciate to determine your fair value. What you then have to do is depreciate that carrying amount, that fair value, over its remaining useful life using a method which matches the pattern of consumption. So if I've drawn a curve, ideally my pattern of consumption, my depreciation rate should match that pattern of consumption. I'm just looking at the little questions that have come through on the chat. Once another asset has been relocated, if you don't need to relocate again next renewal, then do you still need to include the cost? It probably depends. So if I'm saying I've moved a road, I've realigned the road, then probably you wouldn't. Another question here, it does just that some of these assets are not visible while renewing assets. They just pop up. Yep, I get that. Sometimes you don't know exactly, and that's why you've just got to make assumptions, which are typically what happens, and use your best professional judgment on that. So once you've done that, and this is where the integration of asset accounting and asset management comes into play. From an asset accounting perspective, the reason we do financial statements is to report information to general purpose users so that they can make informed decisions about, our performance, etc. For that reason, your asset accounting must reflect your asset management reality. And your asset management reality will deal with what renewal treatments do, what does it cost to build an asset? And then how much does it cost to renew it? And when do I renew it? That becomes my short life part. The balance becomes my recyclable part. And if you do that in your methodology, then you can then lead into strategic asset management modeling and fully integrate your asset accounting with your asset management. So let me just give you an example. I'm just going to flick here. I've got too many things open. So this is taking the information that's come from the valuation, that's come straight into. So this is the valuation tool that we use to do all our valuations. Some councils subscribe to it in their own right and use it themselves internally. That's fine with us. Sometimes we do work for them where we fill the system for them. Sometimes they just do it themselves. But at least it ensures a consistent, compliant methodology. All the data comes into here. From there, they can develop alternative asset management strategies, and then based on
David, sorry to put up. I can't see your slideshow.
You can't see it. Oh,
no.
That's interesting. Let me just share again, and I'll see if that happens. Can you see that now?
No.
What are you seeing?
Your screen top?
The desktop?
Desktop, sorry, yes.
Okay, that's really bizarre. I'll just try again. Shouldn't flip between systems, should I? That's the secret.
That's what's going wrong.
Okay, so let's try this. Are you seeing it now?
No, back to your desktop.
Oh, okay, so let's try this, okay. You seeing that now?
I can't see the presentation.
No, you're seeing something that says Easy Sam?
Yes.
Yes, cool, okay, cool.
Okay, perfect.
Okay, so what I was saying before is that if this is the tool that we use in terms of when we're doing strategic asset management modeling. This sucks all the data directly out of the asset valuation system that we use. And then from there, you have all your asset data. From there, you can very quickly use that data to build alternative asset management strategies. So as part of that process, it's pretty easy to use. It's not overly sophisticated, but it suits most councils. You can run alternative strategies by changing the amount you spend on maintenance, which obviously has an impact on useful life. You can change your intervention points and treatment costs. You can bring forward assets. You can model all those things. So you can see the impact in terms of level of service. So the blue is the baseline, what you're currently doing. The orange is what's proposed. I can see what my cash flows are, includes my maintenance and my CapEx. So if I just want to look at maintenance as an example, I can very quickly see, my new strategy, I'm going to spend more on maintenance now, but what's interestingly, after a few years, I start to spend less on maintenance. And the reason is because as part of my strategy, I've changed my renewal treatment and intervention point, and I'm going to intervene earlier. From there, that will spit out figures like, how much am I spending overall? So you can see here, for example, it's hard to read, but it's saving 5.85% of my cash flow over 30 years. But the impact of that strategy gives me a better level of service over those 30 years. So therefore, that alternative strategy is a better strategy than my existing strategy. And on top of that, I'm saving 5.86%. And then I can see year by year what the impact of that is. And that sort of tool, because it integrates the methodology for the accounting standards with asset management, you can model right down to an individual asset if you really wanted to. So I'm just going to pick an individual asset. And I might go right down, for the sake of the argument, to say the roof. And you can see the consequence of that, what the impact is going to be in terms of different strategies. If I look at individual asset in terms of valuation, again, this is the system that we use to do our valuations. A number of other councils also run this themselves, and there's no reason why you can't do that. If I go down to the assets, this is actually Archdiocese of Adelaide, so it's not a local government, it's a not-for-profit. And you can see we've got different assets here. One of the things I love about this system is that it has its own internal audit process, so that it runs all these validations. If I want to see assets, when I finish my valuation, I can see all the errors and all the warnings. So in this case here, let's see what comes up. I've got one asset with an error and also a warning. If I go to that asset, I can see what the error is. This is telling me that the gross must be greater than 0. I just happen to know with this particular asset, it's not really an error. What it is, it's a market value building. They're going to demolish the building because it's crap. And so the value of the property, there is no value in the building. It's 100% value on the land. And that's why the building value is nil. So anyway, if I look at that asset, though, actually I'll pick a different asset because we don't want one that they're going to knock down. Let me just pick this one. In terms of methodology, if I go and look at this valuation, what you'll see is the asset has been broken down into the different components, which would typically reflect what you do in asset management. Let's just have a look at this asset, see what it is. So you can see, you've got a pretty crappy laundry down the bottom. It's not the greatest building, needs a bit of work. It's an old rectory at one of the churches used as a residential property, I think. If we go and look at that valuation of it, when split into the components, if I go and look at those components, let's just say look at the structure, for example, that structure is split into short life and long life. Now, I've got to stress here, the data which is being collected for the valuation is absolutely no different than what is collected normally or should be collected normally. You're still going to measure the overall building, collect dimensions. You're going to apply an overall replacement cost. You're going to split the building into the different components, like the substructure, structure, roof, fit out, etc. The only difference is you've set up some assumptions that do your short life, long life splits based on your typical asset management strategies. And the system basically does the calculations for you to then calculate your gross, your fair value, your depreciation expense. It's got your useful life assumptions, which are either being calculated or coming from your assumptions. It's calculating a remaining useful life at the whole of component level. It's calculating a weighted average useful life and a weighted average remaining useful life. So if your asset register is set up at the component level, that would be the figures that you would be loading up into the system. And then getting that information out of there, it's as simple as just literally running the different valuation report that you want. So if I want my spreadsheet, and the beauty of this sort of system is that, when you do have impairment events like bushfires or floods or whatever, or you've been waiting and waiting and waiting for updated condition assessments on your road network or something, you can still basically run your valuation, and then once you've got the spreadsheet at the end, if there is a change in data, you just quickly upload whatever the change in data is, and it refreshes the calculations instantly, and you can spit out all your updated methodology reports, valuation reports, etc., for audit straight away. So anyway, that's that system. Let's get back to PowerPoint. Okay, so are we back on the PowerPoint now?
Yes, we are.
Yeah, excellent. So again, this was just a same example valuation, you know, split into components.
Sorry, David, just so you know, it's 351.
Excellent. Okay. So you can see again, you know, there should be nothing complex about this. It sounds more difficult and more challenging, but the reality is it's exactly the same information that you should be capturing anyway. And if you capture this correctly, it then integrates fully to your asset management planning and modeling. Again, that's the component valuation. And I showed you a quick look at asset management planning. So I guess in terms of where we're at, I guess I'm just going to try and summarize the existing requirements as set out by the basis of conclusions. So these are not changes coming from ED320. This is clarifications in ED320 that the existing standard is already black and white. So there should be no discount for restrictions if the restriction will not likely pass to the buyer. That obviously has a big impact for Victoria. You must use the current replacement cost based on the key characteristics and adjust for obsolescence. You must not use the depreciated replacement cost approach based on useful life and remaining useful life. That approach was removed from the standard 9 years ago. So it's time to move on. The depreciation method must match the pattern of consumption. Look, I know, whilst I would argue this, and I have been arguing it for 30 odd years, or at least 20 years, the reality is everyone's probably going to stick with a straight line because that's what the audit officers want. If that's the case, that's fine, but just understand that you know, if your financial figures aren't tying up with your asset management figures in the way they should, it's probably because your underlying methodology is wrong. The important thing here is depreciation also has to be based on the carrying amount for each part, and use the remaining useful life, not the useful life, if you're using a straight line approach. And those components need to be split into short life and long life parts, because AASB 116 is about every different part that has a different useful life. It doesn't mention components. It's about the different parts. In terms of assumptions, you should use market-based assumptions if available. So, you know, don't go make up your own assumptions if there is some market-based evidence what they should be. In the public sector, there is a presumption that whatever you're using your asset for, whether it's a park, it's a cemetery, it's delivery of a community service of some sort, it is assumed that that is its highest and best use, and you need commitment from management to rebut that, to say it's not its highest and best use. Remembering too that under AASB 13, if you have an asset which is not at its highest and best use, then technically you have to disclose that information in your financial statements and list each of those individual assets and explain why it's not highest and best use. I'm yet to see a local government do that for all their land holdings. And in terms of replacement costs, you need to include all the costs, assuming that replacement is in the same location, and you have to adjust for permanent obsolescence and differences in utility between what you've got and what you're going to have. Yeah, in terms of moving forward, how do you deal with this in terms of getting compliance? And I guess there's a couple of things here. In terms of restricted land, don't get too concerned about it. There's a 2-year transition, so just fix it with your next revaluation. If you're doing a revaluation this financial year, I would strongly suggest you have a very deep and meaningful conversation with Vargo to make sure that whatever approach you're going to do, they're on board with. And if they say they want you to discount it, but in 2 years' time they're going to say no discount, then and you're going to be troubled if you haven't adjusted it again, then I would suggest that you would just say no, bugger off, we're not applying a discount now. In terms of market income valuations, and there's not normally too many of them, understand that you've still got to split the market incomes into the different parts with different useful lives. So if you're comfortable with your market values, the easiest way is either just upload it to the software, like the software I just showed you, Asset Value Pro, and do your components and short life, long life splits, because your value doesn't change, but it is going to impact your depreciation. What I will say is when you move to short life and long life splits, do not be surprised if your depreciation expense drops significantly. And I'm talking 30 to 70%, I have seen. Or fix it with a comprehensive reval, but make damn sure that whoever's doing it, whether you're doing it with external valuers, that they know exactly all the stuff that I've been talking about today, or use software that will do it for you, where you've only got to feed in your valuations. For assets valued at a cost approach, if you think your replacement cost is okay, so it's included all the costs that need to be there, it satisfies the requirements of what replacement cost is in terms of, assume it's in the same location, includes all the costs that necessarily have to be incurred, all that sort of stuff. Just use software to fix the methodology, to recalculate your fair value and do your short life, long life splits, or get a comprehensive reval done. If you think your replacement cost though is, of concern, should we say, then realistically, you probably need to do a comprehensive reval. But I will stress here, there are different ways of doing it. You can go down the traditional valuation approach, and I'm more than happy to help you with that, but that obviously costs money. If you want to save yourself a bucket load of money and time, then think about using software to do that. If you want to find out more, I am doing some workshops coming up in sort of September, October around Australia. I've just got two highlighted here, one in Melbourne at the Docklands, another one at Albury. My wife's from Albury, so any chance we get back to Albury to do stuff. There are other ones in, obviously Sydney and Orange and Canberra and South Australia as well. So